Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. One of the strangest occurrences that has happened this year is that the more time passes, the more that the world destabilizes. We went from troubled inflation to skyrocketing inflation to a simple operation in Ukraine to now talks about a potential nuclear attack. Things are regressing quickly, too quickly. Enough that so that different governing bodies across the world have been unable to catch up and take control back. There has been a couple important developments around the world that we need to go over today, and the biggest one is actually regarding the Fed. For months, we have questioned the integrity of the central bank, the capabilities that they possess and their potential to revert the damage that they themselves started when the decisions were made to print money indefinitely. Thanks to a great article put together by the Financial Times, today we ask the question, could central banks go bankrupt? It would appear to be quite hyperbolic to make such a statement, but the answer to this will surprise you. As you may know, markets in the world have had an awful year, and that goes for the stock market as well as the bond market, which is what we are actually going to focus on. You see, no one holds more bonds than the central banks, which have amassed a fixed income portfolio worth well over $30 trillion over the past decade. With so much at risk and the bond markets performing so poorly, it begs the question, do these losses actually amount to something? The answer is dubious, because it is both an astounding yes and an obvious no. To dissect the answer to this, we first need to understand that central banks are very unique institutions. They aren't just any organization with exposure to the markets. On one hand, they have a balance sheet and they have profits and losses just like you do when you open up your broker account. A recent look at the Bank of England's losses show that they currently stand at around $200 billion negative, while the Federal Reserve says it has reached almost $720 billion of unrealized losses, a feat worthy of being gilded on Wall Street bets. So as you can see, central banks do operate similar to us or any other organization in that they get burned sometimes. On the other hand, central banks are constructs of sovereign states, which means they can create money out of thin air if they deem it so. As such, it makes the whole idea of bankruptcy become much more complex because these institutions wave the power of magic in a sort of ways. The fridge gets too empty and they can flick their fingers and fill it up overnight. A chief economist at Morgan Stanley recently wrote a definitive paper on this very subject, and I find it important to revise it now more than ever. In the most essential part, the economist wrote that a central bank's profit and losses do matter, but only when they matter. Back in the 1900s, the subject of economics was called political economy, which means that a central bank loss affects fiscal outcomes and that may have political ramifications, but their ability to conduct policy is never impaired. With the Fed in particular, the income generated on the market account portfolio, including less interest expense, realized losses and operating costs are remitted to the U.S. Treasury. Before the global financial crisis, these remittances averaged $20 to $25 billion per year, but then, they ballooned the remittances to more than $100 billion as the balance sheet grew. These remittances reduce the deficit and borrowing needs. Net income depends on the mostly fixed average coupon on assets, on the share of liabilities that are interest-free and the level of reserves and reverse repo balances, whose costs float with the policy rate. From essentially zero in 2007, interest-bearing liabilities have grown to almost two-thirds of the balance sheet. The U.S. Central Bank's net income has recently turned negative, and this actually explains why the Fed cannot lower rates. This explains why, even upon pleas by the UN, Jerome Powell and his crew simply cannot see a way out. It also goes to show why, even as these rates, so unquote by the media, threaten to push us into a recession, the Fed retorts that they are actually quite low and that they want to hike them up even higher. It isn't because Jerome and friends suddenly have a secret agenda to watch the world burn, but rather because not taking the most drastic action will result into such a catastrophic event that it will not just make 2008 look like a cute little dip, but could set us up for a depression event alike that which we experienced in the 1930s. You will see them in the comments below if they feel brave today. The naysayers that called me a hypocritical fearmonger back in September of last year for calling a bear market in 2022 will come and tell you that I am exaggerating the outcome of this economic event. But I dare them as I dare you to open up a tab on your internet browser and look up the U.S. Central Bank's net income and see for yourself. Central banks cannot back away from inflation and they cannot ease up on rates like most investors want, because doing so would be them starting a collapse. Simultaneously, by hiking up rates, they are ensuring we continue into an economic descent. However, there is a key difference here which we talked about a couple of weeks ago. One involves absolute chaos and total loss of faith in institutions and the government, which will have everyone panic selling on a given day and a market's inability to course-correct action for years. The other, which is the Fed ensuring economic descent, means control. It means that the government and the Fed hold steady the pace by which we go down. Yeah, people lose their jobs and their housing and everyone's money and assets lose value, even as bad as 80% in the worst-case scenario, but by ensuring control on the descent, they avoid panic. That means that once things are relatively stable, economic recovery is a lot quicker, and it also helps with the voters to know the government is present and in charge, even if it's incompetent. Going back to where we left off with the Morgan Stanley chief economist, he also pointed out that most central banks, including the Fed, don't mark to market, so any losses are unrealized and don't actually flow through the central bank's income statement until they have actually sold those assets. That you might think is not a big deal, but you would be wrong, because the repercussions of this reality call into question what exactly does a loss mean for the Fed then. If there any real hit to their capital, any chance of bankruptcy or an inability to conduct monetary policy? The answer to all these questions is a resounding no, so let me explain. Remittances to the Treasury will end, and the Treasury then issues more debt. The Fed, after accumulating their losses and reducing their capital, creates a deferred asset. When earnings turn positive again, remittances stay at zero until the losses are recouped. Profitability will eventually return because currency will keep growing, lowering interest expense, and quantitative tightening will shrink interest-bearing liabilities. We don't have to theorize into how this would work because there are places in the world where these similarities exist, such as in the Czech central bank. The Czech National Bank has had a negative equity position for most of the past 20 years. Managing a small, open economy means focusing on the exchange rate, and most assets are foreign currency denominated. If the central bank is credible and the Czech koruna rises, the value of its assets falls. The same is true for the Swiss National Bank, whose profits and losses have swung by billion in some years, yet it has not lost control of policy. Are central banks going to go bankrupt? I don't think so, but that doesn't mean that peril is not existent. The current predicament is that in order for central banks to survive, markets are going to suffer for a while. The government and the Fed will assume and give the perception of control as we slowly descend backwards, undoing years of growth. But that does not mean implosion. This is why the Fed is so staunch in their opinions and why Jerome Powell gives this weird vibe of not really caring what happens in the economy so long as the Fed can maintain its power to wield itself out of danger as needed. I hope this made sense to you guys. I know it can be quite tricky to understand, but hopefully you guys now fully grasp why the Fed is acting the way it is. Funnily enough, since we are talking about a market recession, JP Morgan CEO Jamie Dimon, who we have had the displeasure of covering, is now touting that serious headwinds are likely to push the US and global economies into a recession by the middle of next year. Dimon had an interview with CNBC, the most trustworthy financial news media organization who houses the greatest investor of all, Jim Cramer. In this interview, he said that there are very, very serious things that I think are likely to push the US and the world into some kind of recession 6 to 9 months from now. This is quite interesting, because this is the same person that just a couple of months was telling investors to not yield to fear and to buy the dip that everyone was selling. As I love to yell on Twitter all the time, they want to make bag holders of you all. They say one thing but act the other, which is why I tell you to never act based upon what these bankers say and instead see what they do. In fact, I would actually urge you guys to pay close attention to BlackRock. Once this corporation starts buying up securities, that will be my signal confirmation that we have reached bottom and are now ready to begin ascending upwards, as recovery is most likely in progress. Of course, this is for investments aside of meme stocks, which are to me a separate entity of its own. I was actually revisiting some statistics today that showed retail investors have directly registered about 30% of the entire float in ComputerShare, which means those shares will not be available for shorters to manipulate. Given the increased volatility that this is likely to cause the price action, I cannot wait to see how this affects the positions of the institutions holding the stock from reaching its MOIS potential. I'm not in a rush for MOIS. I am not panicking. I am simply biding my time and watching the entire system collapse on its own. And with all that said, I want to thank you for giving me a moment in your busy day to listen to what I have to say. I want to hype up my Discord once again. I ran a poll the other day that showed 80% of day traders are losing money. I want to let you guys know that in my Discord, I have offer alerts for both single momentum stocks and options, mostly on SPY. Our results speaks for themselves. Here are a couple of images showing the 11 alerts that went out today. You can trace back this consistency and accuracy for months, which is why I want you active day traders to come over and check them out yourself. Tag me in the main chat and ask me about it so I can give you access to these rooms. Other than that, my Discord has tons of other rooms for conversations pertaining AMC, GameStop and general talk. It's a great server with over 8,000 members who are in the same position we all are. I encourage you guys to come by and say hello. With that said, I hope to see you tomorrow on the next one and to the moon.